thank you for joining us. We're going to talk for the next hour about mergers and acquisitions. One of my new employees, when we had M&A up, thought it was murders and assassinations, but it's actually M&A in this context is mergers and acquisitions. Mergers and acquisitions. And you know, it's obviously coming off an unusual year of 2020. Heard Tom talking about how he thought things would be different because it's 2021, and while much of it feels the same, there may be some differences, and we'll talk about some of those things. But before we get started, what I'd like to do is have everybody introduce himself, and since Steve is center on my screen, he gets to go first, and we'll go Tom second, followed by Andy.
Sure, sounds great. Well, thanks everybody for joining. So I'm Steve Barsotti. I'm an attorney with Kegler. So Randy, to make your associate feel a little bit better, when I started doing this about 20 years ago, I had to ask some of the senior folks here what the N stood for in M&A, because I had no idea what people were talking about. So, and here we are. Take that. You can put a big grain of salt in anything that I say, but you at least know it'll be candid. Been working with the firm for, at this point, like I said, about 20 years. I tend to serve as an outside general counsel role for many of the clients that I work with. And in the context of that, get involved in a lot of M&A, both from the buy side and the sell side. So happy to provide some perspectives.
Tom?
Hi, everyone. Tom Pampush. I'm a partner at Ice Miller. I'm vice chair of the business group here. My practice is a lot like Steve's. In fact, he and I find ourselves on quite a few local transactions anyway. I've been representing businesses, helping them grow and exit for, I've been a lawyer a little bit longer than Steve, but not much. So I graduated in '93. You know, it's fun to be involved in transactions on both sell side and the buy side. And you know, I know Steve shares that sentiment as well. It's really an exciting prospect to help folks, you know, get to that next level, whether it's exiting or building or whatever that may be.
And just for those of you curious, because we've already had 4 or 5 questions on this, that those are earrings that Tom has on, are new 2021 earrings. He's actually using a regular microphone, but it's a new style that he's promoting, just FYI. And then Andy?
Yeah, thanks, Randy. Andy Hayes. I'm president and one of the founders of Copper Run. Copper Run's a middle market investment bank based in Columbus. We have an office in Cleveland and Cincinnati as well. And we do middle market M&A, which is what we're going to talk about, I think, here today. Work with companies generally between 10 million and 200 million of revenue. Help them sell, and then we also work with a lot of buyers. That's really what we're probably more known for, is working with buyers from across the country, a lot of private equity firms specifically, family offices that are out there doing roll-ups of different industries or buying different businesses, and we represent them. So that's what we do, and thanks for having me on today.
Well, thanks for coming, guys. I appreciate it. And I'm Randy Gerber, for those who don't know, with Gerber. And we work with first-generation entrepreneurs exclusively, helping them grow their business with purpose. And we're very dependent on people like these guys here. And I'm super grateful that they are participating and sharing their wisdom and experience. And you know, it's kind of crazy to say this, but January 1st, I've been in business for 30 years now, 30 years and solid 60 pounds. And solid, well, maybe not solid, definitely 60 pounds. Although I try to make it solid. So anyways, these guys are great to have on our clients team to help them, you know, exit their business with purpose the way they started. So a couple of quick housekeeping items. First of which is chat on the sidebar to ask questions. So Annie from our office is going to catalog. We keep getting all these questions about Tom's earrings. She's going to catalog questions for us, and we're going to hold any questions to the end of the presentation as well. So you know, the first topic is a little bit about, you know, how are we coming off 2020 and going into 2021 with trends in the existing landscape, and what do we see different? And Andy, since you're with me, if you don't mind answering first, that'd be terrific.
Sure. It's certainly I think Tom, Steve would probably agree, it's a pretty hot market right now. And coming off an extraordinarily cold market about 10 months ago, as most people can imagine. So, we'll get into a lot of this, but there's a lot of capital out there. The federal government continues to print money and will probably continue to do so, which will drive a lot of these deals and transactions and valuations and lending and all that type of stuff. So it's a strong overall. I guess the theme is it's a pretty strong M&A market that recovered extraordinarily quickly after the initial COVID hit back in March and April.
In your experience so far, how have you seen valuations change and what's happened over the last 10 months? Hot's one thing, right? And
sure.
Then,
Yeah, I mean, for good businesses that have got a lot of characteristics buyers like, growing, profitable, professionally managed, all those good things. It's valuations are where they were 12 months ago. Probably some of the smaller businesses you were certainly, I think, have probably taken a little bit of a hit, but even those haven't been that bad. So it's been buyers are, we'll get into again, this extraordinary amount of cash looking for a limited number of deals. I think we'll start seeing more deals this quarter, February, March. I think a lot of folks, I know we're working with folks that were waiting to get year-end numbers. They're getting those in now, and over the next month and a half, 2 months, 3 months, a lot more deals will be coming to market.
in doing our year-end thinking and planning on behalf of our clients, one of the things that I saw a chart today about the amount of money that's been printed in this quantitative easing, and it's just staggering. And when you look at the coordinated efforts of all the central banks across the globe, that it just doesn't appear that's going to change anytime soon. Whether it should or shouldn't is a different debate, but it doesn't seem like it's going to be the case. And what I found very interesting is that the earnings of technology and new innovative companies really are pretty good and continue to be good. So I just wonder what that does to future deals as time goes on. So Tom, what do you, in your experience, and Steve, I'm going to ask you the same question in a second here, but how about structure? Are you seeing any structural changes in deals and terms that are interesting and different? What's your experience?
So, that's been one of the big changes really since last March. What we experience, Andy's right. This is the biggest difference between what we experienced starting in March and what we experienced in 08 and 09 was there was plenty of capital in the system, and that never changed. And buyers need to deploy that capital like never before, frankly, which is really one of the items that has really helped this market regain its footing very quickly. It has changed. It was absolutely a seller's market leading up to March of 2020. That dynamic has changed somewhat, but it's counterbalanced again by the absolute need by some of these capital providers to deploy their capital. But one of the things that we've seen is, in order to get some deals done, instead of just 80% cash, 20% rollover in a deal, there's now some earnout components to it. And in effect, it's a way to say, you believe in your business and it's going to recover from the COVID impact, and we believe in it too, so we're willing to close the deal, except we need to see the performance after closing, and then you'll get paid, assuming that rebound takes place. That to me has been the biggest change in terms of structure, is the return of the earnout. We hadn't really seen earnouts in any meaningful number in several years. And earnout can be it's a broad phrase, but various forms of seller financing contingent upon the business continuing to perform at some agreed upon level in the future is really the biggest item we've seen.
And Tom, I know one of the deals that we were both involved in last year that didn't happen, it seemed to me there was some pretty specific language around COVID risks and earnouts associated with that. Are you seeing that on a regular basis, or is that kind of one-off here and there?
That COVID has entered into purchase agreements in a couple places. It's coming in on the material adverse effect clauses in terms of whether you're going to close a deal, but it's also coming in sometimes on specific bands of an earnout, whether it's a particular business division, for example, that is being hampered more than another. You can get pretty granular in terms of where you're going to specify this is subject to COVID now, and we expect a recovery over a period of time. One of the things we try and negotiate if you're on the sell side there is to extend the period over which you can earn the full earnout. Historically, you'd have an earnout that's just that next year, for example. Well, if you miss it in 2021, here we are, right? It's 2021 and we're still in the thick of this thing. I wouldn't necessarily want to be tied to only being able to get that earnout this year. But if you had a full recovery next year, you'd like to be able to make up any lost ground that you had in this year, for example.
Steve, what's your experience been with the whole structure of deals in terms and that you've done, or even deals that blew up or got pushed into this year?
Yeah, and it's probably a broader comment that we just saw all kinds of strange circumstances. When we were working on deals back in March, in prior to March of last year, things were, as Tom and Andy have indicated, very favorable to sellers. We had some deals that just blew up completely just because of the market that they were in. Other deals, folks were trying to get creative, and whether that was through earnouts or other sort of structural mechanisms to really shift in hedge valuation and risk. And that's really what I think the theme was last year. Because of the great uncertainty, the folks that were still willing to do deals, even leading up into, say, the fourth quarter, they weren't willing to do deals that they would have done, a year prior, where they were bearing a lot of that risk because the market was so uncertain. So when we're talking about earnouts, we're talking about rolled equity, we're really talking about anything other than cash in your pocket. It's some sort of a hedge on the valuation and a hedge on the risk that the buyer's taken, and they're really asking for the sellers to participate in that. For some, the deals got so hedged, so to speak, that they became very unappealing. Whether that was because the highline valuation was not where where the seller's expectations were, or because the structure made it contingent to a bunch of things that if those things happened, it became almost a risk-free deal for the buyer, and the seller said, well, I might as well hold on to this business. And so we had this interesting dynamic in, say, the late summer, early fall, where we had a lot of businesses that frankly had pivoted really, really well in COVID, were doing really, really well. And in some cases, comparatively well to pre-COVID, in other cases, comparatively well to the market in COVID. But in either scenario, the business owners were feeling pretty bullish about the business itself, but we weren't seeing that reflected in the valuations. And I think it was coming from two places. One, the strategic buyers that would normally be involved in the processes and driving up values were distracted with their own stuff. They're dealing with their own fires. They're trying to pivot their own businesses. Less engagement in M&A, from that perspective than even, one might expect in a period of great disruption. I think that is something that's going to change dramatically in 2021, for what it's worth. And then a lot of private equity in that time frame was taking a very, strong wait and see approach. So the term sheets that we were getting looked to me to be lowball offers. They were sort of can't lose valuations for the PE firms, as opposed to what I would consider to be serious offers at competitive valuations in normal market conditions. So the analogy I had in my head was, the housing crisis, back when that happened, what you ended up having was a drop in value, more a function of the lack of buyers than an underlying impairment on the assets themselves. So I think the same thing's going on with businesses now in 2020. We just had a lack of buyers, which artificially shifted the market or the market valuations that we were seeing in ways that did not correlate to the fundamentals of the businesses themselves. So shifting into 2021, I think the dynamic's going to flip on its head, because those PE groups that were playing wait and see, they have tons of capital to deploy, and there's going to be pressure to deploy them. We have the strategics, in particular the public strategics, that are figuring out, okay, we've stabilized the ship, but how do we pivot our businesses for the go forward? And they're going to be in acquisition mode. And I think the available capital is going to vastly outstrip the number of places that it can be deployed. So I think we're going to see a surge. Combine that with all the stimulus boost and potential inflationary considerations and everything else that you're talking about. I think the story for 2021 is going to be an exceedingly hot market. We're already starting to see that in the fourth quarter of 2020, bordering on maybe even sort of panic buying, if that makes sense.
And so I guess, Andy, and I want to come back to a question about sellers who may have permanently changed their mind on selling, but on the panic buying topic, number one, it's an interesting point, and I like it. You seen that at all?
I don't get that vibe. I mean, I kind of see that in the public markets.
Right.
Why is everybody buying Bitcoin and Tesla right now?
Right.
Maybe that's panic buying.
Great car.
They're great cars, lousy stock to buy. It has been great for the last 9 months. But there's certainly, I think Steve hit on a lot of topics there and they all make sense. Last year, just put some parameters around it. A year ago, U.S. private equity firms alone had over $700 billion of capital to deploy. They've got more today. I don't know what it is now. U.S. public companies had over $2 trillion of capital or cash in their balance sheets a year ago. Now it's probably $3 trillion.
Right.
So there absolutely will be, valuations will naturally probably go higher, right? You think they've got to deploy them, they've got to put it somewhere. I think you're already seeing that in the public markets. I feel like, the old days when PEs were, 15, people thought that was high. Now it's 20, and it's probably going to be 25 in a few years. So, that'll trickle down into the private markets, where we all live as well.
One of the things that's interesting, because we talk about PEs all the time, is that people feel that the buyer is willing to accept a higher valuation. And I feel just don't dismiss the fact these companies are going to improve their earnings and grow into that. And that's one of the things that I do feel a lot of these companies, the pandemic killed a lot of weak businesses, big and small, or permanently impaired them. But the businesses that were able to innovate and change, their earnings. I was with a client this morning that they, in every way, they went from, I can't say it was nothing, but their business went up about 40% in revenue, and they were already good size, but their EBITDA went from 12% to 20%.
Yeah.
And that's with no PPP gyration. That's just legitimate supply demand.
Well, a lot of those businesses, let's be honest, probably, cut some folks and got rid of some underperforming divisions, and,
Right.
COVID across the board probably just expedited things that were going to happen eventually, but hey, we're selling a company that's got a division in California, it's underperforming. We're just going to get rid of it. They probably would have held on to it for another year or two.
Right.
Just things like that across the board.
Steve or Tom, have you guys had any sellers who were all hot to trot to sell in 2020, and then all the reflection that entrepreneurs had around what's life mean and what's important to me, and spending more time with their family and their children, and doing more things that they wanted to do? Have you seen many sellers just change their mind about selling? And you could argue this both ways. One risk, of course, is when you sell your business, that you're selling your business to diversify your risk from the business. And we have lots of clients who think, I don't want to lose my income, and I control that, and I have visibility. I guess for any three of you guys, have you seen any shifts? And so I'm not looking for the exception here and there, but any shifts in thinking around folks that are choosing not to sell because they want to continue to own their business for an extended period of time?
I'll say.
Yeah. Go ahead, Andy.
I'll let these guys talk, but got a lot of calls back in April, May, June from people that said, I'm tired of this. I lived through 08, 9, 10. I don't want to do it again. And I think for the most part, those folks have come back around and said, maybe it's not so bad after all. It's been a little bit of a mixed bag. I'll let you guys comment.
Steve, since you're on our screen here, what's your experience with that?
Yeah, it's hard for me to decouple that from the market feedback, in terms of conversations that we were having and we were getting valuations. So would the story have been different if valuations were different? So the answer is maybe. But, working from the reality of that context, we had many clients that were looking at, okay, I can take either a crappy deal or a decent deal in some cases, or I can continue running my business. And one of the questions is, not just how am I going to spend my time, but what am I going to do, getting to that de-risking question. If I have more confidence in my ability to grow value in this business versus, putting my money elsewhere in the midst of all this uncertainty, and I'm not getting a premium value for my business right now, given market conditions, I think, that made it an easier call. I also feel like across the board, there's a silver lining always to things. And the silver lining of the COVID experience was it caused a lot of entrepreneurs that, in many cases hadn't been forced to innovate in a long time because, they'd gotten their businesses into a good, stable place to really strip everything down to the bare bones and in many cases rebuild it, or Andy, to your point, get rid of things that weren't working and focus on the things that were working. And I think that was energizing. I mean, it was also, I'm sure, exhausting. It was exhausting for all of us to go through everything last year. But I think it reinvigorated a lot of folks in terms of how they viewed their business. And sitting here now, I have a number of clients that were really struggling this time last year. It was sort of counter to the general, M&A was hot early last year, but I had some clients in different sectors that were underperforming and having some challenges. And this year, believe it or not, sitting here, and it's not just because of stimulus dollars, they're sitting with a better business. It's more profitable, or in some cases profitable for the first time. And they're feeling very optimistic. So that's been an interesting trend as well.
What's your experience been with that type of trend?
Yeah, it's really difficult to say it's a function of sort of change of heart or perspective, because that period from March till really July or even August, there was just sporadic activity at best. Deals that were non-EBITDA driven were still white hot. They were still happening. Deals that were already fully cooked were getting done by June. And so, there was a period in there where you're having discussions with clients about their plans. And in some cases, like I said, it's hard to separate what was the driving factor, but definitely in some cases it was I'm not ready to put myself out there for a transaction in this environment, whether that's the environment because they're afraid of what's going to happen on the buy side. They don't want to go to market and then say no and then have to do it again. But ultimately, that changed pretty quickly. Our fourth quarter, we saw incredibly robust activity and folks getting to market pretty quickly, deals getting done quickly again. One of the incredible innovations has been the change in how due diligence and management presentations and things like that have happened in a remote basis. Deals are now getting done with very little boots on the ground, in somebody's facility, whereas oftentimes there's multiple visits, multiple teams of people crawling all over something, and now deals are getting done without that taking place. I know I went a little off topic there, but I thought that was an interesting development from all this.
Well, that's it. What it is interesting, and it's actually pretty relevant, because when you have people, the inspections not being done in person, it changes it a little bit, you know.
And I think Tom, really touched on a point, and I think it is an important point. A lot of these deals got done because they had to get done without doing in-person visits and in-person meetings and dinners and the usual stuff. I think all that's gone forever. Maybe to the extent it was a year ago or 5 years ago. A lot of deals that we worked on, we're working with clients now that are in other parts of the country we've never met in person. I mean, that was unheard of, 10 months ago, 11 months ago. And they're doing due diligence completely remotely, or maybe they hire somebody to go walk around the plant or that type of thing. So, and that's expedited the deals and helped get them done faster.
I know in my own experience, had you told me a year ago we would have chained custodians with never physically meeting people, I would have said that's impossible, but we did. I think there were negative consequences to that, interestingly, but we did it. One of the trends, and at least I feel it's a trend, and I'm hearing this more and more, and Steve, I'm going to call on you to start us off here, that the seems to me there's a lot more conversation and actual deals being done in the SPAC area. And I was hoping that you might be able to elaborate for our audience on this. And, is it a short-term trend? Is it something that's going to stick around? What's your take?
Yeah, it's really interesting to me. And I'll try to not be super cynical about it, but that's going to come through. SPACs have been around for a long time, and for anyone that doesn't know the acronym, it's basically you set up a shell public company for the purpose of then using the money raised by that now public company to go out and acquire an operating business. In that model, in some way, shape, or form, this reverse merger concept to go public is not new. It used to be very I don't know about frowned upon, or at least looked at with a bit of a side eye, because it wasn't always used in, the most robust circumstances. And
with the best sense of purity, how about that?
Yeah. So I'm trying to dance around it. I mean, there's some sketchy stuff, right? It's basically a backdoor way to become a public company. So the structure is not new. Certainly the surge in SPACs and the discussion of that in what I would consider to be legitimate conversations is very new and is pretty intriguing. And to me, it's a function of the access to capital. It's the hotness of the public market, right? I mean, public market is trading at crazy multiples from a PE ratio standpoint. And the capital's just easier to access, cheaper to access at that level. And frankly, I don't, this is where I'm going to sound super cynical. It's kind of dumb capital compared to other, forms of capital. That's not to say that the management of these SPACs, so part of the formation of the SPAC is bringing together a management team that has the credentials to identify and then acquire and manage, these operating businesses. That's not to say that they don't have the credentials to do it. It's just that, in terms of the capital behind it, doesn't strike me as the quote unquote smartest capital from my standpoint.
Well, certainly not the most sophisticated. I think the fundamental issue that the capital behind the SPAC is not sophisticated, generally speaking. One of the reasons I know I want you to keep talking about this, but one of the points I want to make that. One of the reasons why the public money is so interesting is because the supply-demand equation for publicly traded companies has gone down. I mean, there's fewer publicly traded companies, and there's more and more, it's almost double or triple, I think, PE firm, venture capital-backed firm out there than the publicly traded companies. And so you do have this fundamental issue around institutions that manage money on behalf of unsophisticated investors need someplace to put dollars.
And it's,
right.
Back to the point of huge amounts of capital sitting out there, you got to invest it somewhere. And there's less public companies to invest in. Yeah, sure. Hey, if we're, state teachers retirement system or Fidelity Investments, yeah, we'll put in $20 million into this SPAC. It's backed by somebody who had success doing it before. And so you've got all this capital looking for less and less places to invest it. So
right.
I think it's just, it's opportunity investment bankers that, hey, put these together and hey, let's make a fee off of it and we can sell it. So
Yeah, and actually, Andy, you're kind of hitting on the transformation from, I think what Steve initially was trying to be gentle about, 5-10 years ago. I'd have a client that was being approached by a SPAC, and it always just had a little bit of a sheen to it that made you a little uncomfortable, and none of those, and obviously this is a singular experience. None of those panned out in any way and became an actual closed deal. But the transformation that has taken place in the market, it's going to be really interesting. Like from an academic standpoint, from a lawyer standpoint, it's going to be super fascinating, because what makes it really dynamic is, well, first of all, the dollars, right? You go back 24 months, it was $13 billion. And it was all done by like Cantor Fitzgerald and those kind of shops. This past year was 80-something billion dollars. And it's being done by Credit Suisse and, Goldman. And there is real fees to be made by those groups. So they're interested. There's real dollars in the market now. And in some cases, there's real companies that we've heard of. DraftKings is one that was a SPAC IPO, for lack of a better word. Now, what makes it interesting, because for every DraftKings, which appears to be a legitimate investing opportunity, you've got a Fisker, which is a electric automaker who, as I think, doesn't actually have a product or even really any kind of a plan to build a product at this point. And the founder's out, and there's all sorts of fraud allegations, right? And that's sort of the dirty side and historical question mark around SPAC. Well, the reason it works is because if you do a traditional IPO, if you're, DraftKings, you've got to do certain disclosures, and then you go into a dark period where you're not allowed to market this thing. You can't have your CEO on MSNBC. You can't do any of that kind of stuff. But if you do a SPAC, you've already got the public company shell sitting there. And while you're talking about doing a merger, and almost all of them are full-on mergers, right? You've got guys sitting on MSNBC. There's an entire universe of YouTube channels and things like that for individual investors to get hyped up on these things. So that's to your point, Randy, about sort of the less sophisticated money. They're all looking for the next Tesla, right? And, there's plenty of those. Now, so that's my endorsement of Steve's view that, I think, it's super interesting. I think the SEC is going to get interested more as this grows.
My next question was actually the regulatory environment, for SPACs, and I just don't have a sense of that at all. That is it easier environment, or is it going to get more difficult, get more scrutiny?
It's significantly easier because of that. You don't have the quiet period. You don't have the same disclosure requirement to do a traditional IPO. And you can be out there pounding it saying, oh, this is great. We've got these incredible projections that are these forward-looking statements that you're really careful about in filing it with the SEC that are being made in these public forums. That I think is going to be, there's going to be a convergence in terms of regulatory oversight there. But, there are legitimate groups involved in these now that are either, presenting an air of legitimacy or actually bringing legitimacy to the structure. Bill Ackman's, his group's got one where they've got like $4 billion sitting there right now. And I think there's up to another $2 billion from an affiliated fund to go into it. That is a huge SPAC. And one of the investments that's theoretically going to be made is actually a minority investment in Bloomberg. Now, again, typically these are full-on 100% mergers, but now you're looking at sort of minority investors. You're trading on Ackman's name and Pershing Square, and it's going to be interesting, and maybe Steve and I are the only ones that are kind of watching it in that context. But
No, I think it's getting interesting because I know just on our end, we've had a few clients really think about it. And what caught my attention initially was this, are these SPACs going to impact that lower to middle market deals? I mean, is it going to impact a company that's doing $60 million of sales and $15 million of EBITDA? How low will it
I
go?
don't think it's quite there yet, but it might.
Okay.
I mean, if I was a company doing a couple $100 million revenue and 20 or 30 of EBITDA, I'd look at selling to a SPAC. It's another outlet and another buyer out there that's probably just taking up some of the deal flow from some of the larger private equity firms.
How much do you think in a SPAC world is driven by revenue versus EBITDA?
Well, if you're in a hot space, it's revenue, right? If you're ed tech or electric vehicle like Tom said.
But even if those companies wouldn't sell those SPAC, probably, right?
Maybe. I mean, they might.
Yeah, but here's the fundamental difference, right? Between, a private equity group is going to look at a deal and they're going to say, okay, we got to sell this thing or IPO, or we got to exit this thing within a certain time horizon, with a certain target return and all the rest. With the SPAC, it's a public company, right? And it's a public company subject to all the same regulatory thresholds. To Tom's point, there's some marketing sort of advantages because you already have the regulatory infrastructure set. Essentially, the initial shares have already been sold, the capital's been raised. But once the operating business is in that shell, it's subject to all the same public company disclosures as if they had gone direct with an IPO, which makes it less of a compelling case the lower down you go. But at the same time, you could see, the post initial acquisition SPAC essentially becoming a strategic public buyer that then drives up the market for folks in the middle market or lower middle market in terms of roll up acquisitions and all the rest. But I think you're still going to have these public essentially owners. The public float is out there, and it'll be priced the same way that other public companies are priced, which doesn't, at least to me, seem to be based on any rational basis as much as a lack of good places to put your money.
Yeah. So I know we talked about due diligence in some fashion already and about how the remote environment has changed due diligence. Along those lines, will the introduction and competition from SPACs change due diligence by other buyers? Because it's a different lens they're using, right? It's a different outcome in some respects that they're trying to get. And so how does that, and is that a trend that we're going to experience on a go-forward basis?
I think that was a trend before COVID.
Okay.
I think, Thomas, you can comment on that. I mean, more and more deals were, hey, here's kind of take it or leave it. That's what we try to do. We're selling a business. Here's all the terms, getting into very granular detail. Here's the purchase sale agreement that our attorneys have drafted. If you got a ton of changes, we're probably not going to talk to you, regardless of price. So I think that's just another function of it, for sure. The sellers are going to have more power and continue to have more power as there's more buyers, supply and demand, right?
Yeah. So you have simply the introduction of another buyer potentially, and their lens is different when it's all said and done. Steve, what's your take on that, on the due diligence process?
I'm sorry, on the due diligence process, Randy,
Yeah, specifically on due diligence process and in terms of how will that change going forward, or will it?
Yeah, I would echo a lot of what Tom was saying in terms of just the mechanics of it. The other thing that certainly weighs in is the ever increasing ubiquity of representation and warranty insurance in these deals. But I think, streamlined process is going to be the order of the day if we get back into this seller's market where you can really drive it. You can do all the things that Andy's talking about doing. You can force, parties to do their diligence at an earlier stage to invest their time and energy before you even get into an exclusivity. So you're just focusing on confirmatory. I think that that's going to be part and parcel to me. But it's all working on my assumption that it's going to turn into a very sort of seller-friendly market here in the next few months.
So with that in mind, I know when we met originally, we talked about reps and warranty insurance, and what's the status of that on a go-forward basis, in your opinion? And changes.
It continues to be a very valuable tool, I think, for buyers and sellers. I mean, there's private equity's really driven it, and we've gotten to the point where from a sell side perspective, it's become essentially an expectation, and it allows you to avoid escrow mechanisms and all the rest. And pricing has been favorable. There was a bandwidth issues a few points during the year in terms of working with the carriers to get their diligence done. But generally speaking, the market seems positive there.
Tom, do you have
if you're seeing differently
twist on that at all?
Yeah, no, I agree, and it's coming down market. It used to be you're really talking about $50 million deals, and then it was 30 million, and now we're definitely down into the 20 and $15 million deals. It's becoming available and reasonable. That is something that will continue to ensure that due diligence is thorough, because oftentimes, there's either a piggybacking on the buyer's due diligence process, or sometimes an independent due diligence process that goes in there. I'm not sure. Pricing currently is a little bit volatile. Steve's point, there's been some pinch points in terms of actually having folks able to do the diligence for the insurance companies, and that's driven prices up somewhat, but I expect that to normalize here pretty quickly. I do. I agree. It's a useful tool, and it's going to keep coming down market, I think. I have not taken a look recently. As of 9 months ago, it was somewhat undeveloped in terms of claims history. So we may yet get into a period where there are more and more claims against those policies, which of course would then change, probably pricing and diligence and exclusions and things like that.
Got it. And any experience in your part?
Yeah, I mean, we saw it more and more a year ago. I think we'll continue more and more. It'll come downstream now. Again, to go to their point, if it gets too expensive, yeah, that'll probably go away. But it's a great tool for an investment banker.
Yeah.
Makes the deal much easier to close, much more palatable on both sides. So that hopefully will continue.
In terms of multiple expansion, I know that previous couple of years, pre-COVID, that the size of the deal really mattered. That the bigger the deal, the better the multiple you were getting. And with the supply-demand equation, what it looks like it's going to be, and with the continued ubiquity of SPACs, what's your take on multiple expansion in the smaller markets, or is it always going to be that way?
I think there's been some multiple expansion. It will be in the lower end, but again, to your point, there's a reason the bigger companies get higher multiples, right? There's a lot less risk in a lot of different ways. With that said, certainly seeing if you are in the right area for a roll-up, private equity roll-up, even if you're a pretty small business, you can get some great multiples right now. But you got to be in that sweet spot. Like an ed tech, for example, we've done a couple deals. I mean, it could be a $3 million revenue business and selling for a multiple revenue.
Oh, we have a SaaS business that is a $3 million business, and I've already had offers, unsolicited offers, over $30 million.
Yeah.
It's kooky.
You're in the right place.
Yeah.
It's a good place to be, right?
Right.
I would also say if you're one of those businesses, you might want to look at something right now. I want to wait forever because everybody seems right. Tastes change as time goes on.
Yeah, it's wondering. It's an interesting point you make, Andy, that we've all seen this story before. And that's a question I ask myself all the time, because I think a lot of people think, well, we've seen this before, so it's going to crash. It's going to, and certainly when you look at things macroeconomically, you can make the argument why that should happen, right? However, this does feel different to me this time. I feel like the rate of innovation, the rate of change, the rate of reset, the government's response, the coordinated government response I do wonder how long this lasts. I mean, it might last longer than we think.
Yeah, I mean, there's gonna be some fundamental changes. Eventually, we're gonna have some inflationary pressures, right? We haven't seen that
for the last 20 years.
Yeah, and at some point that's gonna happen if you continue to just increase the money supply, right? But yeah, we'll see. Innovation it's an exciting time, right? There's a lot of cool stuff going on, and there's a reason those companies are getting 10 times your revenue multiples and things like that. But there's also a lot of fluff in there too.
Yeah, sure.
And we'll see how it shakes out.
So, guys, if you're in a old economy business, and you don't have the benefit of scale and leverage from technology, and you're not willing to go through that fortitude or that change, is this something that you just reconfigure the business to make it a cash flow lifestyle machine, or do you really change and really try to become innovative in the space that you're in, no matter what? What type of trends do you think going forward? Will the capital be seeking businesses that are really able to scale, that really can leverage technology, that really can grow revenue at just unprecedented paces? I mean, I was looking at a chart this morning that the market cap of Zoom was double all airlines combined right now, and nobody heard of Zoom 2 years ago. And so, who knows where this is going to go?
Airbnb is worth more than every public hotel company combined.
Right. So, is this something that if you own that type of business, and it might be a great business, doing $40, $50 million of revenues, spinning off $10 million of EBITDA, if you're not willing to go through that change or the investment, emotional investment and financial investment and people investment and innovation and change, do you just sit on the sidelines, or do you go through the innovation?
Wow, Randy, that's a hell of a question.
I'm interviewing 60 minutes. This is my, I'm getting 6 minutes for 60 minutes. You'll take me as an interviewer.
I look like let's install.
So Randy, actually, it's an interesting, I'll call it a question that you just spit out at us there. It's an interesting thought because, in my practice, one of the first questions you ask is what are you going to do when you no longer own this business? Or if you're on the buyer side, it's a complicated, how are you going to exit this? You're acquiring this other thing, what's your exit plan? But on the sell side, it's really more, it's closer at hand. What are you going to do? And for somebody who owns a business that's thinking about exiting, and this market we've just experienced has forced upon many of these companies, frankly, the services that a lot of consultants have been trying to get them to buy for years already. And that is, let's get ready to sell. You need to do X, Y, and Z. You should be paring the fat. You should be doing this. Get the personal things out of the business. Make it a check the box type of business for a private equity fund. All these things. Well, in many ways, they were forced to do that just to survive. And so, in one instance, they've already innovated. Some businesses are just not going to be as responsive to some of the technological implementations you could do. But it ultimately comes down to, what does that person want to do and on what timeline? Because ultimately, there's going to be a transition event, right? Death does not wait for any of us ultimately. So,
the only thing to say to that is your lifestyle doesn't necessarily correspond to the peak value of your business. The timing of trying to retire in Arizona might not line up with when your business is going to be the most valuable. So if it's a really good opportunity, don't let it pass by, because we see it all the time. Oh, I'll hold on for another 5 years. Well, things happen. You lose your best top customer, or some technological innovation occurs and your business was worth $40 million and now it's worth $4 million. And it happens. So just be a little cognizant of that too. You got to keep that in mind.
And sometimes those businesses are acquisition targets themselves precisely because they haven't been optimized. And so you can see, roll up where there's a platform that has figured out the tech piece and they're just trying to get either, market share or, customer base or other things that are really driving the acquisition. You're not always going to get, you're not going to get premium valuations necessarily, which I'll put, air quotes around for those types of businesses, but you can still get strong valuations in that scenario if that's really the overarching play. So, one alternative to innovating yourself or just keeping things going and turning out cash is, do you explore either strategic partnerships or a potential acquisition, pathway that might end up filling those gaps?
Of course, there's the all ever popular ESOP option that remains out there that I used to say years ago, the ESOP's the buy our last resort. I don't know that I feel that way anymore necessarily, but that's another exit tool that we're seeing more and more use of. So Andy, I understand we have about 5 to 10 minutes left. And so before we end, I wanted to see if there's any questions.
I do not see any questions at the moment. So if you have any questions, make sure you leave them in the chat and we'll ask our panelists.
Great. So if you have a question of mine, send it to Andy. Otherwise, what we're going to do the next minute or two is I'll ask all these guys to wrap up with the best advice you can give for 2021 with respect to if you're thinking about doing a deal, what should you do?
Hire a great lawyer and investment banker. That's my advice. But just be opportunistic if it makes sense. Keep in mind to really optimize the value too. You're just going to do a lot of things you do to maximize value in bad business, regardless whether you're going to sell or not. So have a good number 2 in place or lined up. Diversify your customer mix. Those types of things that make your business more valuable to you, regardless whether you're going to sell or not.
But even so, I know you were being half funny there, but the reality is is this the type of time that if you're even thinking about it, you should talk to somebody like you?
You should. No, I mean, in all seriousness, you should sit down with an advisor, with a Randy or whoever, and say, I'm thinking about it. Maybe I'm thinking about it in 5 years, but here's some things you need to keep in mind.
I know in our experience, we've had I don't know how many misfires are the wrong term, but people who thought about selling and did some due diligence and they learned some good things in their business to change to come back and later go to market in a better way.
To totally toot our own horn a little bit, but most people in our business should be able to do this. If we sit down with a business owner and look at their financials for 3 or 4 years, ask them probably 20 questions, we can tell them, hey, this is very appealing about your business. This part is very appealing. This part is a big red flag for buyers, and then maybe you can work on it for 2 or 3 years, and hopefully it works out.
Good. Tom, any words of wisdom for our audience?
Well, I think if you're thinking about selling or if you're thinking about acquiring a business, take a deep breath right now. It's going to be okay. Things are still chaotic. But there are lots of folks that can help you through it. And this is not meant to be a pitch for professional services, but not just lawyers and financial advisors and investment bankers. Get your own tax advisor involved. Get all of these folks regularly up to date as to what you're thinking. Too often I'm brought in at the point where a letter of intent's been signed, and I can immediately identify 3 things where it's either it's going to be a sticking point later on in the negotiation, which you don't want, or it's just kind of a miss. And that's just one example. I actually think, particularly if you're on the sell side, going back to that thought process of what are you going to do next? What are you going to do not to annoy your spouse? All of those things should be kind of an ongoing discussion with your advisors. Particularly on the tax side and investment side. If you're going to have this liquidity event, what does that really look like to you and to your family and to your charitable giving and all those things, and to Uncle Sam? It's never too soon to have those discussions. And in many cases, those discussions don't cost money. It's really keeping your professionals and your advisors up to date, because keeping that team together and behind you can really drive a smoother transaction and a better result.
And I agree with that. I mean, it's one of the things that when we work with our clients, we definitely want to be aware of what's going on. We want our lawyers and accountants and wish people talk to Andy and his firm sooner in the process to learn things, because one of the experiences that it seems like it happens every year. I don't know that it happened in 2020 for us, but we get these situations that happen unexpectedly. Somebody goes knocking at the door to buy your business, or there's an opportunity presents itself. 2 years ago we had 4 transactions. All were good, all were positive, and 3 of the 4 were really prepared. And so I think that that's a really astute position, Tom, to take. That keep your team involved and informed, and I guess the speed of the M&A market, the speed of business has changed. Maybe changed the wrong word, but accelerated. So, Steve, any parting words of wisdom at all for the group?
Well, I certainly agree with all that. Yeah, I mean the only other thing I would throw out there is to stay laser focused on operations. I see, a lot of people when they get in the mindset of doing a deal, start to shift all their focus to doing a deal. And your best leverage is always going to be to not do a deal. You go out to market. Andy won't want to hear that, right? The investment bankers they're there to help you, and they want to get a deal done. But and the goal is always to get a deal done when you're going through that process. But it has to be the right deal, and having a keen focus on operations so that the business remains strong will help you from a leverage perspective in the negotiations, and also gives you the ability to say, this deal is not for me, and if that's the best we're going to do, then I'm just going to keep running it. We certainly saw that last year.
It's funny. It's a very good point, because going back to all the deals that blew up over the years, that the entrepreneur takes their eye off the ball and the operations of their business. And one of the feelings I do have right now is that the whole PPP dynamic and the idle loan dynamic, entrepreneurs are confusing operational excellence with financing activity. So many folks, their balance sheets change because of idle loans and PPP, and they're feeling great to look at their bank account, but that was not a result of operating excellence at all. And I think it's a good way to end that. I think really tripling down on your operational excellence should be a theme, because good things will happen regardless if you do that. So Andy, I presume we have no more questions, or no questions at all, I should say.
I actually do have a couple questions that came through while you guys were talking. The first one from Chris is, are you seeing the use of third parties for site visits, drone video companies?
Yes. We have seen the use of third parties. We're selling businesses now where we've hired or worked with like video crews to do virtual tours. So yes, that is absolutely happening.
Is that going to be a permanent trend, do you think? So yeah, so makes sense. Yeah. Do you think the diligence is better because of that, or do you just think it's
I don't know if it's better, but it's from a seller standpoint, it's better. You got less people traipsing through your factory or your warehouse or whatever. And we'll continue to see that.
That's interesting. Andy, what's next?
My last question is a multiple choice question from Robert. What is the most difficult stage of the private equity investment process? A, selection of the right companies, B, creating sustainable, growing the invested businesses, or C, timing of the exit?
What was C?
Yeah.
You say C, timing of the exit.
I mean, I don't even know if I can answer that. Obviously, it's all important. Just having, I think, what really gets private equity firms excited is if they see how, they're the smartest guys in the room, right? If they see how they can transform a business that's doing 30 million in revenue to 300 million in revenue, and if you, have some of those opportunities, that I think that gets people pretty.
Yeah, it's, A, they're always the smartest people in the room, and B, no matter what you say, you're not going to convince them otherwise. That they definitely have their business case made for why they want your business or don't want your business. And I've seen people try to change that positioning, and just, I can't recall a time it's ever worked.
Yeah.
Okay. Annie, any more?
That's it. That's all I got for you guys.
Okay. Thank you, everybody, for participating. Really appreciate it. Thank you, Andy.
Yeah,
Thank you,
thanks,
Steve.
Randy.
Thank you, Tom. Thank you, Annie. Appreciate it. Everybody, enjoy your day and your week, and continue to kick off a good 2021.
Great. Thanks, everybody.
you,
Thanks,
everyone.
Randy.